Hello everyone, I'm delighted to announce the next session, Economic Volatility, Elections and the Remaining Surprises for 2024. Joining us on stage, Hormoz Faryar, Managing Director at ATFX Connect MENA. Hormoz, the stage is yours.
Thank you so much. Thanks everyone. We're going to have an economy panel. So it's going to be really interesting to discuss things like the interest rates and US elections, etc. But before we start, I'm going to let everyone introduce themselves. And as you heard, my name is Hormoz from ATFX. I'm based in Dubai. The rest of you are based here in Australia. So if I start with you, Emily, if you could introduce yourself and your company briefly.
Sure thing. So my name's Emily Dabbs. I head up our macroeconomic consulting team at Oxford Economics. At Oxford Economics, I have the privilege of being able to work with a range of economists across the globe, monitoring the economic environment, and my speciality is here in Australia, which is really great.
Thank you.
Hi everyone, my name is Mi. It's spelled M-Y, as you can see here, so it's always a bit confusing for everyone who sees my name. I'm an economist at AMP. We're super fun so obviously we do invest globally. So my main job every day is doing forecasting for Australian economic data, but we also look at their impacts on global markets, different asset classes in different countries as well.
Hi all, I'm Nick Twidale, as you can see up the back. I'm also from ATFX. I'm the Chief Market Analyst. I've not got such an exalted CV as the two ladies next to me, but we like to focus on the markets with most of our market analysis. I'm an ex-trader, so a lot of what we do is looking at the assets that we have in our area. So I'm a former Aussie dollar trader. We're focusing a lot on the dollar yen at the moment. And we look at the stock markets and overall macro perspective as well. So hoping to learn a bit today.
That's excellent. So we got two economists and a trader. So to talk about the economy. So let's delve into the first question. I've written down some questions, and we might be able to take a question from the audience afterwards as well. So the first question I have is regarding what's on everyone's mind, which is the interest rates. And what's the story with interest rates? I followed it recently because, to be honest, people outside Australia may be not following the story here, but I just want to hear it from you guys, just a brief overview of where the interest rates are, where they came from, and all that. Each one of you, Emily.
Yeah, well, let me take a stab at it, and then I'm sure others will be able to add to some color to the story. From an Australian perspective, just like most other countries, when we saw inflationary pressures rising, rapid increase in interest rates, basically 425 basis points in the space of just over a year, which is quite a significant increase in interest rates. And the interesting thing here is in Australia compared to, say, the US, Europe, UK, the pass-through is very quick, most for household consumers. Most households are on variable rates when it comes to their mortgage, and those rates are fixed for at maximum 4 years. I happen to be one of those, and I'm very, very proud to mention that. The pass-through is very, very quick, and so the implication is that this monetary policy can be quite a quick flow through to economic activity compared to other countries. And a little bit different here in Australia is that our central bank obviously wanted to contain inflation pressures, but also wanted to be able to keep some of the gains they've made in the labour market. And so while that is a very large increase in a very short period of time, compared to some of our global peers, it's not quite as much as would have been expected. And on top of that, at the moment we're in a different period where all of our global peers are cutting, and we're a little bit hesitant to do so because our inflationary pressures are a little bit more sticky, and our labour market, is still relatively strong. And so while we've had our peers like UK, Europe, Canada cut rates, US probably likely in a couple of months, our central bank is trying to take a more hawkish tone and indicating that rates are likely to stay higher for longer. Whether you believe that or not is another question.
Yeah. They kept it. So Australia started later.
Yes.
So everyone thought US and everyone else was late to increase the rates, and Australia was even later. and cut faster. Is that
I mean,
basically-
that was true, but if you think about the central bank, so they look at two things, right? Inflation and labor market, and obviously right now the labor market is still pretty resilient so far. There's not a lot of issues there yet. So their focus is on inflation. But if you look at the inflation path in the past 3-4 years so far, then the US did have a peak in inflation rate 6 months before we did. That was in the middle of 2022. Why? They probably just opened up earlier. They got over, the COVID pandemic lockdowns thing way earlier than Australia. We were pretty obsessed with lockdowns. So, and they also had a massive, fiscal stimulus package from Joe Biden back in February 2021 as well. So they did have that route of inflation earlier than us. And since then, their inflation rate has come down quite a lot to below 3% at the moment. That's on the headline CPI. The PCE is even lower, 2.6%. And it didn't go down in a straight line at all. So what we're seeing in Australia, sure, our inflation rate right now is pretty much higher than most of our peers compared to the UK, US, Sweden, whatever. But it has actually followed the same path as those countries as well. It's come down, but it didn't come down in a smooth path. And again, if you look at the same experiences abroad, we kind of had the same increase in inflation rates from the same factors. It started with goods inflation, shipping rates, all those supply constraints relative to demand. Now we've had all of those unwinding already. And in terms of services inflation, it is mainly driven by wages and labor costs. And wages growth have also started to roll over in Australia. And our peak wage growth is also lower than all of our peers as well.
Sorry, wage growth is lower?
Yeah, so our peak wage growth was 4.1, 4.2%. That's much lower than the US. They had something like 6-7%. So, and it has already started to roll over. So I would also argue that, our inflation story is not that different from everyone else in the developed markets. It's just we're a little bit lagged. So it will take a little bit of time for us to get there, to get about, where 30% of global central banks are already cutting rates. And it will just be a matter of time until we get there.
Yeah, Nick, what do you think? Your mortgages?
I'm definitely out of my league here with these guys. Their stats are fantastic. I would disagree with some of the inflation stats. I think the statistics do tell one story, but I always like to go on a bit of a micro side of things and talking, especially to people that are visiting Sydney at the moment, it's very, very expensive. And just talking to a lot of friends as well, the cost of living there is a bit of a cost of living crisis, and it is in different parts. And I think that's something the RBA is very aware of as well. But it's a real tricky job, not just for the RBA, but for other central banks across the world. And that is being reflected in markets. So we've still got probably one of the more hawkish governors of a central bank at the moment for us, and we've seen that support the Aussie dollar against the US dollar. I'm always going to go back to my currency. And it's also very well supported on the crosses as well. But I think one of the tricks that they're going to have to find, and we're looking very closely at the US as well, like obviously for global markets, we look at how quickly they're going to be easing rates. Now, both in the US and in Australia, markets are still pricing in fairly aggressive cutting from the Fed and we're seeing it probably with the Bank of England and the Bank of Canada as well, which is a good point of example. I think there's a disparity with what we're going to see for markets between what markets are pricing in. Well, there is a disparity, to be honest, with what markets are pricing in and the message we're getting from central banks. So somewhere along the lines, there's going to be trading opportunities for our clients.
So do you guys think that can RBA increase the interest rates? Is that possible while the Fed is cutting? Does that ever happen? Could it happen? I mean, they probably need it if the inflation's high.
I think that there's always a possibility. I mean, you can't rule anything out. From our perspective, the most likely outcome is cuts are next, but probably, like our house view is they're probably not coming till next year, closer to mid next year. And a reason for that is, yes, the inflation pressures are high, and the cost of living point is a really good one. When people talk about inflation getting under control, that's growth getting under control. We're not seeing prices go backwards. We're living at a period of time where prices have gone up significantly wage growth has improved, but not as much. And so really until that affordability story kind of comes into play, where wages pick up to the extent that prices have, some of those elements will still continue to play out in the economy, and I think that's a bit of a risk. I think it would be very hard for the central bank to increase rates when not just the US but globally rates are cutting. That would be a challenge. Because of the way that we are an open economy, there are other ways that would flow through that would be challenging.
I actually agree with both Nick and Emily. I think, number one, the last time the RBA met, they did debate a hike. So, it's not out of the question, right? There's still a possibility there. But then on the other hand, if you look at their concern right now, so they debate a hike because inflation is still too high, right?
Did they debate a hike, but
meeting,
not a cut?
A hike or a hold, and they decided on a hold in the last meeting. That was the August meeting. But then if you think about, if they hike right now, then what does that achieve? So if you decompose inflation into, say, discretionary and non-discretionary inflation, discretionary inflation is, items like things that you can cut back, say, entertainment, traveling, fancy equipment, fancy new iPhone or something. So that part of inflation, it has already gone back down to the RBA target band of 2 to 3%. That's 2.8% on the last reading. Meanwhile, the highest categories of inflation at the moment are in areas such as tobacco prices, university education fees, that's 7% over the years, or utilities rates. And those are things that were either indexed to historical inflation rates or had, a high regulatory part to it. So if the RBA hikes rate to dampen demand even more, how does that fix that essential items inflation part? And obviously it doesn't. So, and those parts are a little bit lagged as well, and I think that's why they settled on a hold rather than a hike at the moment.
Yeah, I think there's a political aspect, as always, with central banks that aren't political. And there is this cost of living crisis, and I think it would be quite dangerous if the RBA did hike rates as their next move, especially with the markets pricing in a cut. We're seeing cutting across the rest of the world. There's a few market participants that are still calling for a hike to really rein in inflation, but I think it could be one of those that it would hit it so hard we'd start to see almost recessionary conditions maybe come through. So it's a very interesting next quarter coming up for traders and for economists and to see where the bank goes. And it's not just the RBA, it's central banks across the world, because we're still really dealing with this post-pandemic environment that's never happened before. So kind of everyone's learning as we're going along, and we have to look at data, and central banks have to look at data and make their decisions accordingly. But also you have to look at what's happening on the street and make those decisions as well. So it's going to be an interesting few months ahead, I think.
And I think too, it's important to look at the data, but also the nuance underneath. Just as Mia has pointed out, when you look at the components of inflation, there's different stories going on there. A lot of those are regulatory. A lot of those are facing pressures for other reasons, like rents, where we've got a supply-demand imbalance. Doesn't necessarily mean that higher rates are going to solve that. But also the same story at the labour market. That's something where people are looking at, the unemployment rate hasn't moved too much. But when you look at the growth in what the jobs are, 4 in 5 jobs are basically in sort of core sectors around education, aged care, health, those type of areas. So they're not really sort of jobs that come with a booming economy. They're jobs that come.
They've also been sectors that everyone knows has been struggling to hire over the last 4 or 5 years. So it's kind of a catch up there. So
when you look at that next layer underneath this data, the top level looks like Australia's been very resilient, and it has. But when you go a layer lower, it starts to look like we can definitely see those signs of slowing. And I think that's what would give a lot of comfort to the central bank, that level.
I'm glad you guys moved on to the growth question, because that was going to be my next question, which is so where is the number? What's the growth now? What is the growth numbers? GDP per capita, GDP? Anyone ran the numbers?
So
Nick, I know you got some.
I got, let me, because I'm dealing with the only stats I got. I think it was 1,800
Gentlemen
billion was
first
the
here
last
in
GDP.
Australia. It's
Yeah.
the opposite. It's the opposite here.
Just go with the thicker one. And just some interesting facts. I think GDP per capita was something like 63,000 US. I am prepared to be corrected by more knowledgeable people. So growth is still looking high from a statistical point of view, but once again, we've got to look at certain risks that are out there present in the economy and the global economy at the moment. And you know, we were talking before about potential for geopolitical tensions to rise across the globe, and something that we focus on in markets very at the moment is what's going on in the Middle East. But as you said, there's potential for real big tensions to increase local to us, which would be the China-Taiwan situation we were talking about earlier, and obviously with the US elections, which I won't segue to that because it's the next part, but that's something else that could spark some interesting issues. So.
Yeah, what is the growth? What is the growth per year or per quarter?
So I have two parts to this answer. So number one, GDP numbers are very lagged, and it's actually a bit backward looking. So, you know, you don't know if you're in a recession until, like, say, 2 quarters of GDP. That's already negative. But the latest GDP numbers, which was 1.1% over the year, is extremely weak in Australia. That's the weakest growth rate that we've had since the 1990s, outside of the pandemic, of course. A normal growth rate in Australia is more about 2.75 to 3%. So that's, you know, 1/3 of that. That's extremely weak.
What was the rate? What was the growth?
1.1% versus a historical normal rate.
Almost zero, historically. Close to zero for you guys, basically.
And the most concerning part about that, I think, is that it's pretty mixed so far. So on one hand, you have government spending increasing 4.6% over the year. So that has been driving a lot of growth in the past few quarters. On the other hand, you have consumer spending or dwelling investment either extremely weak or even going backwards in the past year. And so that was the Q1 numbers. So it's a bit of like an old story already. But if you look at more, I guess, higher frequency data in the past few months so far, then you do see, say, for example, retail sales, which accounts for about 1/3 of the household spending in Australia. We've had a retail recession for 2 years in a row, basically, and it has gone down 0.3% over the last quarter. People are like cutting back spending aggressively, and the only thing that's been supporting spending so far is basically population growth, which is again 2.5%. That's double the growth rate of GDP in Australia. So at AMP, we actually do think that there is a very high chance of a recession risk in Australia, especially given that weakness in household spending.
Yeah, Emily, I think you mentioned something about growth. So is the growth, it's a pretty bad growth story then? You have a bit of growth because of people coming maybe, or?
I think if you strip out the population, we've gone backwards significantly. I think, correct me if I'm wrong, your financial year was about 1.4 and population was about 2.5. So that means per capita, we're really talking about a backwards growth of about 0.9%. So that's pretty significant. And as you pointed out, when you unpack it further, there's different stories going on here. Consumption story is woeful. And I think anyone with a mortgage or anyone renting, anyone paying power, insurance bills understands that the pressure that cost of living has had on being able to spend. And we've seen that through those discretionary items coming through, particularly retail. Also shout out, I don't know if ABS will ever see this, but please keep doing the retail series because you're cancelling and that's going to kill me. But also on the investment story as well, it's very nuanced. The dwelling story is very horrible. We've obviously got a very big weakness in the housing market, given the sort of cost pressures of producing. There's a lot of demand there, but not at the right price level, and with the costs the way they are, it's very hard to get developments up and running. So a lot of that development that's occurring is literally approvals that were made, and it's just taken a long time to flow through to actually being created. And on the investment side, the sort of civil side, a lot of that's coming through in government spending and government projects. So, as those start to taper away, which they're around for a fair while, so it does provide some support there, there's not a lot of growth impetus other than population. Saying that, at the end, starting sort of FY25, we've got a few good news stories. We've got tax cuts coming through, so people are seeing more money in their accounts on payday, and hopefully that provides some floor to consumption. We are starting as well to see that viewpoint of, sentiment starting to turn with the prospect of interest rate cuts, so providing more support to investment businesses, etc. So it's, from our perspective, we're kind of at the bottom, fingers crossed, but it is a slow trajectory up.
How much tax do you guys pay? Is it a high tax country here?
45.
45?
Top band.
That's the
Top
top
band.
marginal
That's
tax
the top.
rate.
That's for traders.
That's why you're dashing out so
Okay, so it
quickly.
starts somewhere 20 to 45 or something?
But I think the most concerning part about that tax story is that our tax brackets are not indexed to inflation. So the past few years, we've had this bracket creep. So, wages go up, so you basically get pushed into the higher tax bracket. With that's not actually meant for you. So more and more people goes into that highest tax bracket. And that's why when the government says it's a tax cut, it's actually not really a tax cut. It's more like an indexation of the
readjusting
previous
brackets,
tax
yeah.
rates.
I
Yeah.
We don't
think
have
most-
brackets. In
yeah,
Dubai,
I
we
would-
have zero tax, so that solves that
Yeah,
problem.
well, you're lucky. I think most households would probably agree that the tax cuts are going to be almost inconsequential against what's probably going to be much more hefty mortgage payments. And as Emily said earlier, once people are falling off what were pretty tight fixed rates and moving on to the variable side of things, there's going to be a lot of pain out there.
I mean, there's also some there's some supportive fiscal policy at a state lens as well. So the energy bill relief, I'm sure many households will be very thankful for. I mean, up in Queensland, they're doing free public transport, which sounds fantastic. But I think as well, like the energy relief is an interesting one. Generally, economic theory says when you give money to people, they go and spend it. So even if you pay your energy bill and then you get $500 back, you still spend that $500. You don't kind of, in your mind, equate the two. What policy has done here is instead of giving that cash to you, they're paying your energy bill for you. And so there is a viewpoint here that
That's like a subsidy.
a subsidy, yeah. So it
not
provides
good.
the relief for households in terms of they're not paying that outlook, but they're not having cash in their pockets where they're going to spend and add to inflationary pressures. So, there is a bit of a trade-off here where government, both fiscal and from the fiscal perspective, is trying to support cost of living pressures without putting too much pressure on inflation as the central bank is trying to, contain demand. So it's a tricky line to be walking, but I think ultimately what we see is that when you add it all up, at this end of the calendar year, there is a fair bit of support coming through to consumers, and also a bit of a light at the end of the tunnel.
I just want to add a little bit about the households, and I actually do agree that there will be some support on the household levels. But then on the flip side, though, you have the labor market still weakening. Like, yes, it's very tight right now, but the labor market and strong wages growth have been driving resilient consumer spending so far, and that seems to be fading. And second of all, that population growth story is going to decline this year as well. The target is for 2.5% population growth from last year, going down to 1.5% this year. So if you net both of that effect out, then there are both upside and downside risks for aggregate consumer spending in Australia, in our view.
Nick, anything to add?
Yeah, I think going back to sort of my markets perspective, one thing we also have to look at when we're looking at Australia, obviously we're a huge exporting country, so we're going to have to look at what the global growth story is, and it's something we focus on. And like when trading the Aussie dollar, it's a major factor, and like most traders will be looking at that on a daily basis. So as soon as we see risks increase, and particularly if it comes from China or the US or our bigger trading partners, then that's a real big impact for Australia. And some of our commodities, and a lot of commodity prices, are at all-time highs. Anyone here from any of the brokers will know where gold is at the moment. Congratulations, yeah, congratulations all of you on that. It's at record highs. But if that gets hit, and if the global growth story changes, and that gold's probably one of the worst examples actually, because you might see some haven buying, then Australia does get hit a lot harder, and from a currency perspective as well, than most of the rest of the world, because we are so dependent on foreign income. So I think that's something to take into account, looking at the domestic side of things. But from a global markets perspective, the international global thing will and does have a much bigger effect on Australia than certain other jurisdictions.
Yeah. I was going to say, probably you guys are, after hearing me say that we might be in a recession, but we don't know it, I would bet you guys are in a recession in Australia the next couple of quarters, unless you have a lot of people coming in here. But then again, you have the gold story that you just mentioned. I'm wondering, you guys export gold as well, so maybe the gold money is making up for it. So it's complicated here.
That always doesn't
Unfortunately, I
get
think
spread
the
around
iron
so
ore
much.
story is a bit of
Iron
a struggle there. Yeah, but yeah, you know, I think
What's
without
the price of iron ore, by the way? Is that high,
Actually
low?
bounced back up to above $100, but I think it's
That's
about like
it's a
that,
good
okay.
price.
Well, in this environment, if you compare that to January, that was $144, so
Oh,
not
it's
really.
not very high.
It-
Okay,
it's very
decent.
mixed.
But it's a good point about the, that's a good example of our global exposure. We are ultimately a small open economy, which means we are a bit at the whims of the global environment. And some of our key trading partners, you know, obviously China from an iron ore perspective, but also they play a big role in tourism and students and things like that. So anything struggling there, which is struggling, does have those flow-on effects to the Australian economy as well. And even more so geopolitical tensions. I think it's, you know, quite interesting how resilient the global economy has been given what's going on in the global economy as well.
Yeah. I think global economy has been like Australia when it comes to geopolitics. I would have thought there's more turbulence by now, which brings me to Trump and Harris. I know that doesn't impact you guys here in Australia maybe, but maybe it impacts China, then impacts you guys. So
I think
Yeah,
the
it's-
US impacts everyone, doesn't it, Nick?
Yeah.
Yeah, it does. I mean, it's you know, our markets obviously follow on from the US every day, and that's my main focus when I wake up in the morning. But it's going to have a huge effect on the Australian economy. So it's going to be very interesting to see where things pan out, whether Trump gets in or Harris gets in. I think most people we've got known risks with Trump and probably slightly more uncertainty with Harris because we were chatting before we came on that she's still a bit of an unknown quantity, but we do know that there's high risk with a Trump presidency again. There's a lot of protectionist policies, and there's let's be honest, there's some fairly strong anti-China rhetoric from Trump in the past, and maybe we're going to start to see, you know, we haven't heard the words tariffs appear, whereas 3 or 4 years ago it was like every day it was like a new tariff chat, and you know you'd be writing it in your report. So I think we can't underestimate the impact on the Australian economy that the upcoming US presidential election will have.
yeah, let's make that clear before you go. Who is your biggest trading partner? Is China, right?
Yes, so China accounts for 30% of our exports, so obviously we're pretty dependent on it. And then in terms of the iron ore story, actually just ran some numbers yesterday for notes that we were doing at work. And iron ore exports account for 7% of our GDP. That's massive for like a single product, and 80% of those exports go to China. That just shows how dependent we are. And strong iron ore prices have been a key driver of our budget surplus, our federal budget surplus in the past 2 years as well. So I think everyone in Australia should be pretty worried about that at the moment.
Yeah, but that's China. So Trump-Harris, how's that impacting that iron ore and all that with China?
So first of all, Trump. I guess Trump is threatening to put on tariffs 60% on everything from China and 10% from everything else. The average U.S. imports tariff rates at the moment is between 3 and 4%, and that has been very low since the 1930s, since the deregulation since then. But on our calculation, a 10% tariff rate from everything, 60% from China would push the average tariff rate to 17%. 3% to 17%, that's pretty massive. So the impact of that would be more on inflation in the near term. That would increase either tax tariff costs or increase logistics costs for companies. You know, they might have to export products to a third country like India, Mexico first before getting into the US. So either way, like companies will adapt, but that will definitely push up inflation rates, not just in the US, but globally, given like how big of an economy they are. On the other hand though, I think with Harris, so right now, obviously, she's a big question mark right now. She doesn't have any concrete agenda. So the most likely outcome is that she's going to continue Biden's strategy in the past few years. And if you, again, look at tariff rates, Biden didn't actually roll back any of the tariffs that Trump put up back in 2018 with the trade war. So they might not be as friendly to China as everyone expects.
So Biden's not friendly, Harris is not friendly.
So no one is really friendly to China, to be fair. And another staggering statistic that I saw yesterday is that Trump only mentioned the word tariff twice in the Republican convention last month. He basically like got rid of that narrative. I know like he's a bit of like, he says whatever's fashionable at the moment, but he didn't even mention the word tariff in the last month.
Did Harris mention it?
Not really, but she did. I think she will continue protectionist policy still. But anyway, so that story is just to say that I think either way, they would both be quite hawkish on China. And given like rising geopolitical risks at the moment, rising trade protection policies, I think the lesson for Australia is that we probably would have to diversify our economy a little bit so that we're not
get
so
some tourists,
dependent.
get some finance conferences. Maybe.
I totally agree.
Emily, who would you choose, Trump or Harris? If you're selfish, thinking about Australia only, Australia first, as they would call it in America, who would you pick?
Look, I think they both pose different outcomes. There's, from a Trump perspective, there's probably more of a long-term structural concern around the decoupling of trade. Australia is a beneficiary, if you like, of that trade. We've got, we don't just trade with China. We do send a lot of agriculture products over to the US as well. So, and Europe, UK. So this sort of anti-trade element does pose risks for us, and we saw that when China put their own tariffs on our wine and our lobsters. Anybody having a lobster here would have been happy. Anyone sort of in the lobster industry would have been really challenged. So, I think that from our perspective, the Trump presidency poses a longer-term risk to trade relations and basically decoupling of that, and the longer-term implications for productivity growth globally and then flow through to Australia. But there's some good points on the Harris presidency. We don't know a lot about what that looks like.
She's in power. How can people not know? She's in power and nobody knows what she wants to do.
I think she's hoping to reveal more of her platform in the next meeting that they have. But we do know that in general she has a little bit more of a lean, the policies that she has announced around supporting households with cost of living. So the potential there is stronger short-term economic growth from that consumer-led area. However, there is a risk that puts inflationary pressures, and so we see interest rates higher for longer in the US likely flowing through to Australia. So, there is a bit of a trade-off between the two. But the thing we're not talking about here is what do we mean by a win? Do we mean power in both houses, or have we got split? There's a lot of factors here, and I think ultimately there's a potential where we have an outcome of a presidency, but fractions in the houses versus Senate, and hence the ability to actually push through policy is limited, which might result in a bit of a situation where it's neither good nor bad. And I think those are some of the risks that we look at. So it's definitely an election we'll be looking at closely from that Australian perspective.
A lame duck president, as they call it, is it?
I mean, just as I'm thinking that could actually be the worst result for maybe the US and Australia is if it is split and there's just nothing getting done in the States, and we know how fierce US politics is. When we started talking about this, I just had a little glance up to make sure there was no one sitting on any roofs. Yeah, but that could actually end up being one of the worst scenarios that we have, where with any government, I think, when nothing's getting done and there's no clear direction. But especially with how charged the US political environment is in general, and how charged it is at the moment. That could actually be worse than, depending on your view, a Trump or a Harris-dominated government. So,
I think a side effect split Congress is that, say, Harris right now, she really wants to spend a lot of money on maybe expanding the child tax credit, giving grants for first home buyers, but a good outcome from a split Congress is that she's not going to be able to enact a lot of these policies, and that would put less pressure on the current US deficit at the moment, which is around like -6 or 7%. And that has put a lot of pressures on the bond markets so far. So, less spending on a way is actually good for the bond market, because there's so much interest cost in the US right now. And again, that could ease that a little bit as well. So good and bad.
Can I go briefly to the next question, which is, in my opinion, there's been some surprises this year. what is, in your opinion, the surprises that has been this year or coming? Briefly, Nick, any surprises for you that happened this year? Globally or in Australia?
I think there's been a fair few surprises.
Yeah,
and
assassinations and all that.
Exactly, and you know, from a market's perspective, only a couple of weeks ago we saw what was essentially a flash crash, but the unwinding of the carry trade, stock markets getting hit. I mean, one very interesting thing which is very relevant today is we've got NVIDIA earnings in the US.
6 a.m.
At 6 a.m. for anyone that's still up, I might say. We'll still be going. But options pricing for that is 10%. So they're looking for a 10% move in the NVIDIA share price. Now that equates to about $305 billion worth of value, apparently, and about a 7% chunk of the S&P. Correct me if I'm wrong here. So there could be some big surprises in the market within the next 24 hours.
That could be the surprise of the year, you think?
But yeah, well, maybe not the surprise of the year, but I think on a greater macro scale, I think that US election is one of the things that, you know, we've already discussed.
AI answering my questions was my big surprise this year. So, which is NVIDIA.
I don't need to be up here. You could have just done an AI piece. I think just kind of following on a bit there from Nick's point, to me the biggest surprise is if you look at the amount of different factors that the economy is facing. We've had record high, like a very fast increase in interest rates here in Australia and globally. We've had a lot of geopolitical tension and changes. You know, we've had a lot of sort of surprising things happen, and yet we haven't seen big reactions to that. And I think, you know, even consumer sentiment is very weak, as it should be, and yet things are holding up okay. And I think to me that's kind of a big surprise in the year so far, is that despite a lot of the uncertainty that we're facing and the challenges from an economic perspective that we're facing, we seem to be quite resilient. I think looking forward, you know, I do think to me that I'm a little uncertain about looking at things like the US election, interest rate cuts potential here in Australia. I think any of those surprises could be just enough to kind of start a little bit more volatility than we've kind of experienced over the last 12 months. Would be something that I'm keeping an eye on a bit. That's what keeps me up at night, not the NVIDIA price, but you know, maybe that should be.
For me, surprises in the next, I would take it a bit more medium term. 3 things. Number one, valuations for equity is actually pretty stressed at the moment. So that's the, you know, earnings or dividends premium over bond yields, and that's actually sitting at like 10-year lows at the moment. So that's putting downside risks for equities. Second of all, like we still have a high recession risk both in the US and Australia, because once it happens, it tends to roll on really fast, and we don't know yet. So that's really high in my opinion, and that put downward pressures on earnings even more. And third of all, it's definitely geopolitical risk around the Middle East especially, and that would put a lot of volatility in terms of commodity prices in the next few months. So 3 things.
Yeah, I think in conclusion, we're probably all agreeing that maybe one of the surprises is we haven't seen as much volatility, as most of what we're talking about is actually a little bit negative or an increased risk. And I'm the same. We're watching the markets. It's been pretty much one-way traffic. You buy dips in stocks. And most other products have actually been relatively calm and not experiencing too much volatility. So maybe that's the surprise, is that we actually do start to see some volatility, because
yeah, I think the opposite. I think the surprise might be that we don't get any surprise this year.
Yeah, exactly.
I think we're done, so we might be able to take a couple of questions from the audience about the economy and their mortgage rates, or who's the best mortgage provider, or whatever. So, any questions? We got 1 here, 2.
Hi guys. Can you hear me? Yeah. Thanks very much for your presentation this afternoon. It's been very informative and quite diverse in the issues that you've covered. My question relates to the decision made by most of the Australian banks to actually pull back on interest rates. Sorry? Oh, yeah, okay. So my question relates to, excuse me, the decision made by most retail Australian banks to actually take a forward position and pull back on interest rates that they're paying for depositors? Is that something that they're trying to influence the decision of the Reserve Bank, or is it just a position to try and lift their net interest margin?
I guess I can take this, but you can add anything. So I was actually pretty surprised by that as well. But I guess there's two things that drove it. One is market pricing for rates. And right now, the Australian market is actually already pricing one full rate cut for this year, even though the RBA is still pretty hawkish. So I guess the cost of funding for banks kind of follow market pricing, and that has gone down a little bit. So that's the number one reason why. And I guess second of all, I guess the mortgage wars, like trying to compete between different banks, has kind of intensified a little bit again. So right now, home sales volume has actually declined a little bit since the peak. I think it's like only 60-70% since the peak in 21, 22. So obviously, there's not much business making right now at the moment. So they're trying to get a bit more market share. So there's a bit of competing there.
That's interesting, Nick, isn't it? The RBA is saying we're not going to cut this year, and the market, the traders are saying you will cut this year.
It's kind of where we kicked off, yeah. So if you speak to the guys on those interest rate desks at the banks, then they're going to go with what they're seeing and how the market reacts. It's not always right, but once again, is it the banks putting pressure on the RBA? The RBA's being very strong. Michelle Bullock in particular, she is remaining hawkish because she's looking at the market from one perspective of what their mandate is, and banks have got to trade what they see. Like on a trading desk, they'll go, this is what we're seeing, and we're pricing in one full cut by December in the market, but the RBA's they've pulled away from a hike, but they're saying we're not cutting anytime soon, and it's at the moment it's Q1 2025, and that could get pushed out. So I think it's a really good point, but I don't necessarily think it's the banks pushing as such, and I do like to blame the banks normally, especially when they don't pass on the rate cuts. But in this instance, I think they've kind of got, I think they are a little bit ahead of the game.
Yeah, I think that's a good point. Is also on the deposit side. They face the two elements of lending and deposit rates that they're having to pay, and so obviously they're cutting rates from a lending perspective, but definitely also on deposits. And I think it comes from those same pressures of they're facing market pricing elements rather than with the central bank. There is also that disconnect what financial markets are thinking and what the RBA is saying. And I think at this stage it's still a bit of uncertainty, but at some point the two shall meet in some way. The other thing to note as well is that Australian banks are relatively profitable, and so even though we've had hikes and they get passed on in full, as mentioned, cuts don't always. So there is a bit of fat there, I think, that the banks can play with potentially around that, but they are looking at balancing both their deposits and their loan lending as well.
We had one more question here. Yeah, you can hand over and then see if you can press up on the...
Hello? It's working now. Guys, first of all, thank you so much. Very insightful, I would say. So my question, it's pretty broad about the US dollar. We've seen US dollar hitting 7 months low last week or this week, I'm not too sure, can't remember now. And when it talks about USA, yes, elections are one of the points, but we can't forget that in 2 weeks we're going to have FOMC deciding the rates. And in my opinion, at least in my opinion, is one of the most important of this year, as 60% of the market, 63% of the market is pricing for a 25 basis point cut, and the rest is a 50 basis points cut. 2 weeks ago it was 50-50, right? 50 was pricing for 50, 50 was pricing for 25. If it comes, most probably a 25 basis points cut, how would that impact the US dollar, and how, because we still have high unemployment, 4.2, 4.1%, rovering around that numbers. NFP numbers are decreasing, as we can see. But still, it's, in my opinion, it's not cooling off that much because inflation is still high. at 3.2. So I just want to listen about your opinion as well.
Can I jump on that one? That's I agree with the point I think you're trying to make. It's those interest rate chances of the 25 to 50, as you said, it was 50 and 25 just a couple of weeks ago. And recent data I don't think was too poor. So I think personally I'm feeling some of the downside moves we've seen in the US dollar over the last week or two is maybe unjustified, because that interest rate expectation is still really on that 25 basis points cut. Now, we have got three key data updates before we hit that September meeting. So first one, we've got PCE on Friday, we've got non-farms the next week, and we've got a CPI print to come as well. So I think personally, we'd have to see two of those three come in weaker, or one of them come in massively significantly weaker. It could be non-farms or it could be the CPI, to lock in that 50 basis points. So I think that's a key factor. And don't forget, interest rate differentials aren't what always affects the market as well. We've been talking about geopolitical risks. So the dollar will appreciate if we do see an increase in geopolitical risks as well. It is a haven currency. So I think where you're going is probably along with a lot of my thinking recently, is that maybe this dollar downside move, and we are at 7-8 month lows, is probably a little bit overdone for the information we have at the moment.
Correct. Yeah, I agree with you.
We have a question there, and then we're done, I think, as well. If you could hand over the microphone two rows behind you, and then we're done.
Thanks to all of you. Can you hear me? My question was for the whole panel. Given that the regulation in Australia is a lot better.
Sorry, can you hold it a bit closer?
Oh, can you hear me? So given that the regulation in Australia, I feel, is much better than in the US, and we have better protections in banking, do you think that maybe the big surprise is that we start actually decoupling our relationship from all these global shocks, and actually we fare a lot more resilient while the US actually flounders with all the geopolitical risks and all the economic uncertainties ahead, while Australia actually does quite okay for everyone? Thank you.
So sorry, just to play that back, your question is there a potential here where Australia does relatively well despite the rest of the world kind of floundering? Look, I think history shows that Australia's economy is dynamic and it can weather a lot of different storms. But at the same stage, we are still small and open, and we do face those same risks. I would say that the US economic outlook generally impacts Australia more from an investment and source of funding, and that can limit sort of activity in different parts of the economy where that investment is required. Whereas, from the China perspective, economic downturn there, which we are going through, you can start to see that through things like iron ore prices, which have, slowly weakened, tourism numbers, student numbers from China. So I don't think that we are immune. I think if we see a situation where the global economy is weak, it would be very hard to see Australia benefiting. But, the impact of if the US is floundering, and say we have, a situation where we've got a bit of a lame duck presidency there, for example, that doesn't necessarily spell a bad situation for Australia, because it is, we are a bit more diversified than just the US. And also from that financial market perspective, our government and private debt, etc., is in Australian dollars, not US dollars. So there's some sort of elements there that put us in a good situation. So if it's just one economy, there's potential there depending on what's going. But if it's a global, I think that's a challenging picture to paint. And I love to paint scenarios and economic scenarios, but I think that one I'd struggle to find realism.
If you sell a lot of lentils and lobsters to China, you will do well.
Lobsters are back, I hear.
mean, throughout COVID, we did have a mini trade war with China, and we actually managed to find other customers for it. So we didn't really suffer from that at all. Like, our trade surplus actually went up throughout the past 3 years. So I'm not too worried about that. Like, it's not to say that we shouldn't diversify, but
I think, and I'm obviously older than my other panelists. I go back to the GFC where we did have global issues, and Australia rode out the GFC very well. But one of the primary reasons was because we had support from China. So Australia did escape through that, but I think now we're in a very different situation. So from a trading perspective, I think if we did see those escalations in global growth, then we're kind of screwed.
Okay, we're out of time, so thank you very much, everyone.
I didn't want to finish on that note.